Hello, this is Kopi Time, a podcast series on markets and economies from DVS Group Research. I'm Timur Beg, Chief Economist, welcoming you to our 132nd episode. Today we have with us Dr. Prakash Kannan, Chief Economist and Director of the Economics and Investment Strategy Department at GIC, one of two key sovereign wealth funds of the government of Singapore. Prakash is responsible for developing the top-down view on the investment environment, as well as the asset allocation strategy for GIC. Prior to joining GIC in 2012, Prakash worked with the International Monetary Fund. I know him from those days, the Central Bank of Malaysia, Bank Negara, and GTE's pension fund. Prakash Kannan, welcome back to Kopi Time. It's been a while.
Thanks, Timur. Good to be back. I can't believe it's been 4 years.
August 2020. These were the early days of Kopi Time when you were kind enough to join me. Lots has happened since then, Prakash. And macro remains exciting.
First, congratulations. I think the podcast has definitely gone from strength to strength. I think it was, you was at episode 24, I believe.
Correct.
I was
That's
on.
correct.
Now it's 100 and change. So congratulations.
I have been able to run it because I've had, friends and colleagues like you come and support it. So again, Prakash, thanks for coming back today. And like I said, back in 2020, I think most of the podcast was about dealing with pandemic economics. We can hopefully put that aside, if not even behind for the time being. Prakash, let's start with some macro discussion. And then I do want to hear about your views on asset allocation in this environment. But to set the trajectory, let's start with the US. Lots of chat about Jerome Powell's Jackson Hole speech. September is probably most likely the beginning of the rate cut in this cycle, and people are trying to price in the 2024-2025 scenario. Your thoughts?
No, thanks, man. And look, I think it's a great place to start. For better or for worse, I think what the Fed does really matters, not just for the US, but I think for the rest of the world. I think, really thinking about the question, we have to take both the expected path for rate, but also the outlook for the economy and inflation together. Sometimes you have these discussions where people just focus on the rates, but ignore actually what's happening in the macro context. So if I start by looking actually at what's priced in, you have about 220 basis points of cuts between now and the end of 2025, which is roughly 100 for this year and about 120 for next year. Now, you rarely see this kind of extent of cuts outside of a recession. So in that sense, it really is a very strong kind of a degree of monetary policy kind of easing that's being priced into the market. So when I look at that, and then I try and square it with my central view of the economy, the amount of cuts being priced in seems a little excessive. Our baseline is still for a soft landing, but importantly, with a slightly sticky path for inflation, such that it would likely end 2025 still with a two handle. And so, if you take that into context, we think likely that you're not going to get this amount of cuts that the market is currently pricing in. But of course, that's the central scenario, the alternative scenarios around it. We do actually place a relatively high probability on a recession scenario, about 30 to 35%. This is, about twice the kind of unconditional mean. And a large part of that is just based on the dynamics that you're seeing in the labor market. Now, if you do get that scenario, then I do think actually the Fed has a lot of ammunition. And I think they will actually act in a fairly aggressive manner. The other scenario is, of course, that actually we're wrong on inflation and actually it comes down a lot faster. That I think is a bit more consistent with what the market is pricing in. Not too bad on growth, but actually a very fast disinflation process. And of course, we have to talk about the elephant in the room, which is the U.S. election. Depending on how that pans out, I think there is a scenario where the Fed may just want to pause and wait until you get some clarity on policies, because across both candidates, a lot of the discussion has been on kind of broader issues, let's say immigration, crime, the economy, etc. But very little kind of clarity in terms of what exactly type of policies they would deliver. So that again, I think would probably lead to a bit more caution, I think, from the Fed relative to what's priced in.
Right. And I think I am very much in line with you that to prognosticate about a recession just around the corner sounds really a bit far-fetched to me. In the past, Prakash, I mean, we've only had proper recessions with proper shocks, which are, by definition, not really predictable, like the pandemic or the financial stability issues around 08, 09. And the market can't predict that. So if it's pricing it in, that narrative, in my view, doesn't carry a lot of weight. Whereas, to your point, that if inflation starts surprising on the downside, then just the fact that we don't need to have such high real rates makes sense. But still, it has to be combined with some degree of weakness in labor market, would you say? Because if labor market does not weaken materially and we rule out a recession, then sustained cuts could lead to undue, softening of financial conditions and create financial stability issues on the other end, like a melt-up scenario.
No, I think that's absolutely right. The one thing unique about the U.S. is that there actually is a bit of an asymmetry with regards to the sensitivity to interest rates, mostly because a lot of economic entities in the U.S. actually have optionality when it comes to refinancing, right? So as interest rates go up, as you know, a lot of households are on kind of fixed rate mortgages, which have very long duration relative to other parts of the world. Corporates actually also have turned out their debt, such that pass through of higher interest rates to balance sheets is a lot slower. But if you invert the process, actually then you suddenly could get the opportunity for households to refinance much faster, households to even take potentially home equity withdrawals. So you could get actually an asymmetric response to cuts, which I think, going to your point, would lead to, I think, to a bit of a melt-up scenario. And I think here, the risk is that there's perhaps too much emphasis, I think, placed on this concept of a neutral interest rate, or this R star, which is, as you know, unobservable. And so if there is a belief that policy is quote unquote tight, just because it's relative to this conceptual R star, that pressure to cut may actually be a lot more than what is actually necessary for the economy. So yeah, I agree with you. I think that there could be that scenario where the Fed kind of, in a way, underestimates how much actually R star has increased over the past few years.
That's right. Prakash, I want to talk a little bit about the Treasury. I've seen some articles lately talking about the fact that the Treasury's focus on issuing bonds at the short end of the spectrum, as opposed to the long end, constitutes some sort of a QE, which has sort of offset the Fed's QT. Do you have any view on this issue?
Yeah, I think the challenge with the Treasury is that they actually have to do a lot of issuance. And that's the function of the large amount of deficits that actually is being done. We have kind of reached a tricky position where kind of Treasury auction announcements have been almost seem to be like market moving events. I think there will be a time where they will need to issue a lot more duration. In a sense, they are kind of getting up to that 20-25% amount of kind of bills relative to overall issuance that I think is roughly their sweet spot. Having said that, it has actually helped the balance of liquidity in the market because by issuing much on the shorter end, actually they have, in a way, as you were saying, offset the amount of QT that has been going on. Our own estimate is that, as you know, QT is already reduced in magnitude, but we think that runs probably until about the middle of next year. and then that too will eventually stop. And perhaps at that time, the Fed can actually extend the duration of their borrowing.
Right. I also think that some of the stuff that the Treasury is doing, as much as the market would like to follow minute by minute, I think it is fairly predictable. It is fairly stable. And I think they're focusing on the short end of the curve does not reveal any desire to sort of offset the Fed's moves. And to your point, we also estimate that at the current pace, by the middle of next year, might be the longest the Fed can go. A final word on global liquidity, Prakash, not just Fed's operations, but the things that are happening at the Bank of England, PBOC, Bank of Japan. And one concern that I hear going into 2025 is that the Fed may be doing its thing, but there are other things happening elsewhere, which might constitute somewhat of a liquidity crunch for banks and financial institutions and the private sector in general. Your sense, do you have any concern with respect to liquidity?
Yeah, I think, we looked at this a bit, and my sense is that the both awareness by central banks on this issue, as well as actually the existence of new tools, I think do actually limit the likelihood of any kind of sharp liquidity shock. I think the standing repo facility, the Fed, of course, is something new relative to the last kind of repo scare, and I think this actually will help to be a little bit of an offset. And plus, I think there is a lot more kind of discussion with kind of market participants. There is actually also, Laurie Logan, who's now the Fed president over in the Dallas Fed, also carries, I think, a kind of a wealth of knowledge with her. And so, in fact, we pay a lot of attention to her speeches, I think, on the balance sheet, and I think she also has a good pulse of what actually is kind of the true demand for reserve assets from the bank. So I think in general, both the awareness as well as the tools that are out there, we think actually limit the likelihood of a big liquidity scare.
Because the awareness that you're talking about beyond the US, when you talk to central bankers in other industrial and emerging economies, do you feel that they are picking up that cue from the Fed and would probably be amenable toward more activist intervention with respect to liquidity going forward?
Yeah, I think that definitely is there. I mean, you see it in the ECB as well. I think those discussions are happening, and I think in the previous, I would say, 2 years or so, I think that emphasis on while doing QT, but also kind of making sure that liquidity institutions and the banks are kind of adequate, I think has been quite, I would say, a key input towards the way that they've been actually structuring, the various degrees of asset purchase programs that the ECB has been doing. So I do think it is top of mind for a lot of the policymakers, and I do think that they do have the tools to kind of overcome that.
Right. I do this chart, Prakash, which is a G4 central bank balance sheet as a share of G4 GDP. And from that metric, we're not that far from going back to the pre-pandemic levels of liquidity. So in dollar terms, of course, it's much, much bigger. But nominal GDP has expanded quite a bit. So I hope that, not just the Fed, but other central banks, including the ECB, but also probably Bank of Japan and others, are taking note of that.
Yeah, but I think the important thing is it's not so much GDP. It's actually you have to look at bank assets.
Yeah,
and I think that part, in a way, that credit creation process has actually been not as strong as GDP, right? So, when we look at what we think would be the kind of adequate level of reserves, scaling it by bank assets, we think kind of forms a bit of a better base, and which kind of goes back a little bit to the earlier discussion, because the cycle has been very unique, right? It's not been a credit driven cycle, but it's actually been income, right? And it's income in a sense of transfers from the state to private entities. And so, that's one reason why when interest rates went up so much, you didn't have that kind of a large contraction effect on real economies, just because balance sheets were in general a bit of a better shape. So in that sense, how much reserves bank need actually may be a little bit less than I think if you were just to scale it relative to GDP.
Right. Unless, of course, we see finally a resumption of the credit cycle, and then the ratios could evolve quite dramatically going forward. I guess that's a 2025 story. I mean, we're thinking and hoping from a banking perspective that as rates come down, there might be a little more intermediation. Even if it is not in the US, elsewhere, there is certainly a lot of impulse coming from the governments for the investments sector to pick up. So maybe it will happen. Prakash, so staying with the story outside the US, thinking about Asian economies, my take is that, 8 months into the year, they've held up pretty well. Trade has done better than what I would have feared coming into 2024. Consumption is decent. What's your assessment of the performance of Asian economies this year?
No, actually, I'm very glad you brought this up, because I think it actually is an unappreciated fact in the sense of the degree of resilience across a lot of emerging markets. We were computing the other day this metric, which is, let's say you strip out China and you look at EM ex-China growth relative to developed markets. In the early 2000s, this kind of EM ex-China cohort actually was outpacing developed market growth by about 4 percentage points. Then, actually, after the global financial crisis, that actually fell quite rapidly, and you had, at some point, even less than 1 percentage point in terms of the outperformance relative to developed markets. And this is just, it kind of goes against all our usual convergence thinkings with regards to, EMs kind of growing at a much faster pace than DMs. And so, I always feel like when we look back at that post-GFC period, a lot of people talk about secular stagnation in the US, but actually the secular stagnation was happening in the emerging market space. And that also actually passed on to equity returns. We did a decomposition of equity returns over the last decade, just kind of seeing why did EMs perform so badly. And the biggest piece of why EMs performed badly was just that earnings just didn't grow. And so, I think what we have seen, not just for the first 8 months of this year, but also actually last year, has actually been quite phenomenal. So that differential between EM ex-China and developed markets has now gone back up to 2 percentage points. And if you use some proxy of new orders and etc. Coming out in PMI, actually, that could be forecast to go back up to about 3%. So that outperformance of EMs relative to DMs is actually picking up. And we know at least structurally why that's been the case. I think the national balance sheets has been a lot stronger. There's a much more kind of reduced reliance on foreign flows. And I think there's just in general fewer imbalances. But there is also a cyclical story. I think as you know, a lot of the countries, especially in Asia, I think outside of Singapore, not a lot of countries actually did fiscal stimulus to the extent that you saw in the US, Europe, etc. And so the output gaps, I think, were still quite negative, coming into 2022. And so in that sense, I think there was a little bit of slack that the economy could grow into. And then I think the other thing is, the resilience of EMs, particularly Asia, is the flip side of the resilience of the US, right? The one thing which is been very positive in the US has actually just been manufacturing capex, and manufacturing capex in structures usually kind of helps EM exports. You've seen it in Korea. You've seen it in this part of the world. So I think that part of the kind of resilience of the US, I think, has also helped this part of the world. but you're right. It is actually a really underappreciated phenomenon. And actually, even if you look at the turmoil that happened in early August, once again, EMs in general did okay. I mean, you had the bifurcation between the Latin American economies, which were the kind of recipient of the carry trade flows, and those currencies unwound quite sharply. But in this part of the world, actually, suddenly you had number one, the prospect of the Fed actually cutting, and two, you had the yen appreciating. And so, you had Malaysian ringgit, rupiah, won, actually appreciating quite a bit in this region. So, I do think that the EMs are definitely in a much better position now than they were, I think, post GFC.
Absolutely. So, Prakash, you know that we at DBS did a collaboration with Bain & Company and Angsana Council looking at Southeast Asia over the next decade. And one of the points we made in this report, and I think it is reflected very clearly by what you just said, is that the last decade or two's somewhat underwhelming performance should not be construed as a marker of things to come, because during that time, balance sheets have improved, the quality of human capital has improved, and a lot of stars have aligned, so to speak, for the region with respect to China plus one. So the next 10 years, in my view, actually looks pretty good, particularly from an earnings perspective. I would not look at the lackluster performance of past decade as a marker for things to come at all. So glad to know that, you're on the same page.
Yeah. I think, the challenge for EMs, or particularly investors in EMs, has always been how do you get access to the growth, right? So, you'd be hard pressed to find the kind of growth numbers you get in this part of the world, literally anywhere else. But at the same time, like at least on the listed equity space, returns have just not been that great, especially for ASEAN. And so I think really kind of being selective, thinking about the particular sectors. And then I think of course India is one of the few markets where markets have been compounding at 12 to 14% a year, actually since the 90s, right? So kind of through any administration. So really, I think you got to pick your spots well here.
Right. But also that India story is so instructive for policymakers in ASEAN that when you have that virtuous cycle, if you will, of capital markets, dynamic, growing very fast, creates this entrepreneurial energy, which then becomes sort of fulfilling. And that's what we're seeing in India, on a regular basis, tremendous wealth creation, which in itself is feeding into innovation and new companies and new ideas. And it's heartening to watch that. I think ASEAN used to be like that pre-1997, Prakash.
No, you're right. I think it still is, right? I mean, if you look at, of course, Indonesia has some of the more kind of well-known startups, whether it's Gojek, Tokopedia, Bukalapak, but actually, even if you look at Malaysia,
yes,
I think the entrepreneurial spirit there is actually phenomenally strong. And so that ecosystem around, that kind of China plus one strategy, I think is actually thriving. And back to your point, I think that to me is the kind of the raw ingredients that you need to then actually build, capital markets, etc. Around. And at least on paper, that they have a lot of these good policies, really trying to help the small mid-cap space kind of get better access to financing, promoting a venture capital ecosystem. So things like this, I think, once it's really well developed, I think we'll capture even global investor interest.
Right. And I think in the region, there's some frustration about we need deeper capital markets and better stock markets. But I think I heard someone say that, without good companies, you can't have good markets. It's not necessarily a chicken and egg thing. You have to have good, exciting companies first. I am looking forward to the next round of entrepreneurs and next round of value creation in this region. Prakash, let's talk a little bit about China. We have had a couple of years now where a steady drip of policy easing has been the characteristic of the Chinese economy, but concerns around property sector consolidation is still substantial. And now lately, very recently, we've also seen this issue related to this sharp decline in interest rates around everybody crowding into the Chinese government market. So some thoughts around China.
Yeah, look, I think the starting point for thinking about China is really that trend growth has come down, right? One of the reasons I talked about doing that EM-DM comparison in terms of growth rates, kind of excluding China, is because you don't want to kind of take that huge decline in trend growth to distort that relationship. So as you know, China 10, 15 years ago was growing between 8 to 10%. We now have trend growth at about 4 and change. And we think that actually falls to about 3 and change in the next decade. So it really is a very sharp fall in trend growth. And a large part of that is just demographics and also actually a moderation in productivity. And so, that I feel kind of needs to recalibrate in terms of actually how fast we think China could grow. And to me, the way I read policymakers' read of the economy is that actually they've also kind of incorporated the fact that trend growth is lower in the way that they are thinking about stimulus. So is a kind of a 5% growth if they achieve that this year, is that really an underperformance, or is that kind of in line with where trend growth is? And I think in some sense it is actually already going down to where trend growth is, and that's why I don't expect kind of a big bazooka type stimulus that they will do. But having said that, I do think that there is an issue of kind of lack of animal spirits that's if not addressed well, I think could potentially lead to kind of a sharper fall in growth and a bit more deflationary dynamics. What I think there, if I look at the kind of the output from the third plenum, also the July Politburo meeting, it looks like these issues are front and center. I was surprised just to hear how much, like the phrase kind of supporting consumption has come up, I think, in recent policy statements. So I think that knowledge of what needs to be done, everything from supporting consumption to improving the balance between center and local government finances, improving land reform with regards to mobility of people, improving urbanization. And I think all these things are definitely the right direction of travel. So to me, it really is just kind of an execution issue that is a little bit lacking.
I just want to throw in one nerdy economics question, putting markets aside for a second, Prakash, which is this whole notion that the US Treasury has brought to the fore, the China overcapacity argument, and its role in destabilizing global markets and creating deflation risk. Although I thought the US Treasury would worry about inflation risk, but overcapacity seems to be the other end of the argument. What's your sense of overcapacity?
Yeah, it's funny, as much as we think about this kind of lack of animal spirits in China, I think in the sectors for which China is thriving, EVs, batteries, solar, I mean, the competition is absolutely fierce. we've seen, we've met companies where, the margin squeeze has just been quite striking across these sectors, just because there's this very strong competition, and the quality of the products that they're putting out, I think, is just quite phenomenal. I've seen kind of autonomous driving developments in China, which I think is much better than anywhere else you feel in the world. So I find it hard to think really in terms of overcapacity. I think in that sense, I mean, as you know, the world needs a lot of these kind of green products. I think the challenge really here is what happens if more and more countries put up barriers with regards to China, which I think then, in a way, is going to feed a little bit back more into the deflationary challenges that you have in China. Ultimately, as we know, we just need to find ways to boost demand. And I think that's where that whole emphasis on consumption, if it actually gets more traction, I think that will be a better way of solving this, kind of quote unquote overcapacity problem, than I think really trying to limit their exports.
Okay, in case our listeners missed it, I just want to reiterate the point you made in a slightly different way, because that's a really cool one, which is concerns about overcapacity with trade restriction measures and treating domestic supply chains would actually compound the overcapacity problem on a global systemic scale.
Yeah, I think so,
Yeah, well put. I think this issue came up in the context of India's ambition to have its own solar industry when the Chinese were supplying those solar cells with rock bottom prices. And I think my initial inclination was exactly that if you want to have even more solar cells in the world, how does it help from a global capacity perspective? I think, at least in the context of India, Prakash, I see a little more calibrated approach toward dealing with China and its production in the last year or so, not necessarily tariff barriers and protection, but other ways of making the relationship a bit more balanced, which I like. I would like to see some of that from the US. But Prakash, I think independent of November's election outcome, I don't think the US policy on China is going to change much.
Yeah, no, I think you're right. I think in a way, as much as the current administration is trying to focus on the small yard, high fence approach, to me the risk is twofold. One is that you are introducing actually new policies. For example, restrictions on the outward flow of capital. And once I think you introduce new policies, I think that the risk is always that these things start expanding. And second is, I think from a financial investor perspective, I think there is actually already among a lot of kind of US institutional investors, some form of financial decoupling that's happening between the US and China, and I think that's very unfortunate. So that part of it, I think you're right. I think would be relatively robust to the different administration, but I think that in theory that more targeted approach is still better than I think a large blanket tariff or such policies, which I think will hurt not just Chinese manufacturers, but also US consumers. And it's probably with the saliency of inflation, I think still in the background. I think this could really put the Fed in a very difficult position if US policy kind of goes down that path.
Yes, I fully concur. Speaking of issues that sort of afflict the market, and one is, of course, the issue related to the US election, but the other one is around currency market. You touched upon this briefly earlier, Prakash. Let's expand on that. So what are your thoughts on this currency market volatility that we experienced in late July, early August? And do you think that the conditions that made that happen are still very much in place, and therefore we could have a recurrence?
Yeah, so I think what's very unique in this cycle is really both cyclical as well as kind of, in a way, structural divergence across the major economies, right? So, you've got the US, which was kind of operating above capacity, is kind of coming back towards some concept of equilibrium, and then you've got Japan, which is kind of exiting deflation and kind of starting a normalization process, and then you've got China, which is as I was saying, kind of dealing with this slowing trend growth. It's funny when you go to Japan, people actually talk about the wage price spiral in a very positive light, and in fact, it's something that they're trying to encourage. Whereas, if you go to Europe, the conversation there is about we are trying to avoid the wage price spiral. So I think ultimately, when you're faced with this kind of both cyclical and policy divergence, it is going to be currency markets that play a lot of the adjustments. And I think central to that, I think really is the yen. For historical reasons, etc. But also the fact that it was one of the markets where you really had the largest policy divergence between the US and Japan. And so, I think that direction of unwind, we think still has a little bit ways to go, because we do think that the BOJ actually still normalizes from where they are today. If Japan does manage to get a 2% inflation, we estimate their trend growth at slightly below 1% real. So that's an economy that's operating at about a 3% nominal growth rate. It's not too unreasonable to have a policy rate that is around 1% or even up to 1.5% in the long run. And actually, if you look at the way that the JGB curve is priced, at the back end of the curve, actually there is a lot of hikes that's being priced. I mean, the 10-year rate is kind of north of 2.5%, right? So in that sense, we do think that you are going to continue to get this divergence where we think Bank of Japan's kind of interest rates are going to be going upwards, and the Fed's kind of going to be going downwards. So while the bulk of the moves have happened, we do still think that actually the yen could potentially appreciate a bit further from here. But like I was saying, I think actually for our part of the world, it's actually a good thing. It's a good thing in the sense that I think it does give room for regional currencies here to appreciate. Because as you know, the big thing about Asian economies is that we're all net surplus economies. And the thing with net surplus economies is that, outside of India and Indonesia, we tend to be low yielders. And I think in that low yielder environment, it was just very difficult to kind of get exchange rates on a stable or appreciating trend when U.S. interest rates were north of 5%. So I think with Fed coming down, but also with the yen appreciating, I think it does give this region a lot more policy space. And kind of going back to China, I think it gives them a lot more freedom to cut interest rates than I think it was the case maybe about 2 months or so back.
Right. No, absolutely. And also, Prakash, one observation and one follow-up question. One observation is that unlike the two previous episodes in the past quarter of a century when the BOJ tried to do liftoff and had to scale back its ambition immediately because the economy fell apart, I think things are fundamentally quite different. Japan's industrial sector for the first time in a quarter century seems energized and new investments are taking place. So I think there is a fundamental underpinning to the growth story than just cheap yen feeding exports. But my follow-up question was on your observation on low yield, Prakash, the carry trade story. We had a lot of borrow in yen, invest in U.S. tech story. We have elsewhere in Asia, there is also elements of carry trade. How big or meaningful is this dynamic?
Yeah, it's a very difficult number to estimate. I think even our own estimates prior to what happened in the first week of August, I think the moves that you see in the market were a lot faster and a lot more wide-ranging than even we had thought. I think you do have a lot of hedge funds that were kind of funding themselves from yen, and in that sense, you whatever the funds were investing in, were quite broad-ranging relative to just the usual, yen Mexico or yen Brazil types of trades. So I do think it is actually quite extensive, and I do think that it's just very, very hard to monitor. I mean, if you take the Chinese renminbi, for example, it was a little bit of a crowded trade as well, because if you had the view that the Chinese policy was going to be easing, the economy was slowing, that you had a view that the exchange rate was going to depreciate, you were paid to hedge
Yes.
the currency, and so in that sense, it was a pretty crowded trade. And so when that whole thing unwound, once again you get that appreciation in the renminbi, and so I think really trying to trace down where all the flows were going in this kind of more opaque markets has just been very difficult. I mean, I think even Malaysian policymakers were surprised at the extent to which the ringgit appreciated.
Yes.
It was actually quite a phenomenal thing. But as I was saying, it's in line with what they were trying to achieve, and I think with that, it does take does give them as well as the whole region, I think, a lot more breathing room.
Yeah, just things are becoming a little more balanced. I like that very much too. Prakash, you might remember from our graduate school days this paper by Guillermo Calvo called Varieties of Capital Market Crisis. I think that was the first paper I read on sort of contemporary financial crisis, building on stuff that Krugman had done earlier in that previous decade. So one point that Calvo made was that portfolio managers have a bunch of positions and they try to balance it. And sometimes when they have a negative view on one asset, it manifests in them selling in other assets. So that rebalancing approach then manifests in all sorts of things. So the reason I bring it up is because it is related to the next two questions, and these are the two final questions of this discussion. So first one is on gold. The kind of rise in gold that we have seen, does it reflect this portfolio rebalancing thing that Calvo was alluding to in his paper?
I think actually the drivers there I feel are slightly different. Prior to 2022, there was a very tight link between gold and real interest rates, and for right reasons, right? I mean, you could think of real interest rates as being the kind of opportunity cost of holding gold, which doesn't give you any yield, and so when interest rates go up, actually the price of gold goes down. And then just after the I would say about March 2022, you had this decoupling. Now it's interesting because around that time, of course, the Fed started hiking rates, and so the presumption was that actually gold prices were going to fall. But you also had the Russian invasion of Ukraine, and I think that in a way catalyzed a new driver for gold, which I think was very different from the traditional drivers, which is real interest rates and the dollar. And this driver was actually from central banks. And so if you look across, the data that comes out from the World Gold Council, demand for gold by central banks actually really, really shot up from that period. And And I think that at the margin has been, kind of a big support for gold, which is interesting because if you look at the ETF flows on like GLD, for example, actually that's been flat to kind of coming down. So it has been, I think, a lot more central bank flows, and then recently a bit more retail flows as well. So I think it's been a very different driver, and to a certain extent, I think probably is keying off a bit more on kind of geopolitical risk than it is about portfolio rebalancing. But I of late you do find that the correlation has kind of come back a little bit more, but with the dollar. So as the dollar has been falling, you've seen that kind of being a support for gold.
Right. It's like a heads I win, tails you lose for gold. If rates go up, the gold goes up because of geopolitical concerns, and rates come down, then the old relationship comes back. Okay, so this brings me to the portfolio construction question, Prakash. How would you design a portfolio given everything that we just talked about across duration and asset classes?
No, I think that's a good question. I mean, at least in a way, that's where the rubber hits the road. I think we've just kind of been through a very unique decade, right, where actually diversification hasn't paid off at all.
Yeah.
Not only would you have wanted to be in a fully equity-centric portfolio, but actually you wanted to be fully in the US. And in fact, I think most managers you go around talking to, the question is, why bother diversifying? Why bother buying anything other than the S&P? But I do think that we've kind of gotten to a point where diversification, I think, is actually going to matter a lot more. The one positive thing I take away from the episode that we saw in early August is that when actually faced with a growth scare, where the market was, for, you could argue, reasonable or not reasonable, putting more weight on a recession scenario, actually bonds did their job, and rates rallied, right? So I think what we are thinking about, and what I think most investors are thinking about, is actually that this is the time that you do actually want to do a lot more diversification. Part of the story, in a way, even if you have a kind of a soft landing baseline scenario, risk premia are actually quite tight. So whatever measure of valuations you want to do for the US relative to where real rates are, even if you look at credit spreads, by and large, actually, you're not getting compensated for a lot of risk. But I do think actually, kind of diversifying the portfolio, and kind of going back to the discussion on emerging markets, if you do get that soft landing scenario where the Fed is cutting because inflation is falling rather than growth, and the dollar comes down. I mean, historically, this has been a great period for EMs. So I think that's one aspect. The other one, I think, is that some of the more structural forces that we didn't get a chance to talk about. Whether it's climate change or the energy transition, a whole range of industrial policy, build out of capex related to AI. A lot of these things, in a way, push out the investment curve a lot more. And then, when you think about how much the governments are spending, we bring back the savings curve. So you put two economists in a room, and you always have to talk about curves at some point. So I think if you look at that intersection between savings and investment, I think in general rates are in term equilibrium a bit higher, but I think in general they're also a bit more inflationary. And so finding ways to protect your portfolio from higher inflation I think is a place that you should be focused. And I think, I know we said heads you in, tails you in thing for gold, but I do think actually, in that scenario of kind of a more monetary-led inflation, I think gold actually does well. But I actually also think adding a little bit more commodities, real assets, I think to the portfolio, I think do make a lot of sense in this environment, because we are likely to be faced with a lot more supply shortages, and this is the kind of environment where I think getting that bit more ballast or support for your kind of core equity position, I think will pay off a lot more.
I think that's a great, astute observation, Prakash, because when I talk to investors, to your point, that dominant view is, what's the point of investing beyond the U.S.? It's been so great, but the sands are shifting. And if we don't take positioning now, it could be that, we look back and say, well, this was the time to make the adjustment. So I really appreciate your view on that. Prakash, final question is on the private space. The public markets have done their thing. We've seen good equity performance in the West. We've seen fixed income rally around expectation of some soft landing. But then there's this intrigue around whether there's a lot of leverage buildup in the private markets because they're not subject to mark to market. Maybe we don't really know how big the damage is. But so far, with almost 2 years and counting of high rates, we haven't seen any accidents in the private space. So are we out of the woods?
Yeah, look, I mean, in some sense, I think that the rebound in the public market space has helped, just in terms of anchoring valuations for the private space. But I think going forward, if you think of returns in private assets coming from, as you mentioned, leverage. Second is actually kind of valuation re-rating. And the third is actually kind of value creation, kind of getting better EBITDA growth. What we're seeing is that we just can't rely on the first two forces anymore. And it really has to be about value creation. So I think that will be the big challenge for the private market space, is that if you were actually just resorting to the first two pieces, you're just not going to get the kind of growth that you did in the past. So what we've been doing actually with a lot of our portfolio companies, as well as via the GPs, is actually putting more emphasis on the third part. And this is, I think, the kind of true strength of private markets, particularly private equity, in that you actually have a control premium, right? You do have the ability to make those changes and actually help create that value. So it is going to be a tough period, I think, going forward for the space. But I think it will actually lead to, in a way, the way I think about it, actually a more sustainable growth trajectory for this universe.
That's a very good point to end. Prakash Kannan, thank you very much for your time and insights. Thanks for coming back to Kopi Time.
Thanks, Jamal. Take care.
Great to have you. Thanks to our listeners and viewers as well. Kopi Time was produced by Ken Delbridge at Splice Studios. Violet Lee and Daisy Sharma provided additional assistance. It is for information only and does not represent any trade recommendations. All 132 episodes of the podcast are available on YouTube and all major podcast platforms, including Apple and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling PBS Research Library. Have a great day.